Good day. Thank you, Ellie. Thank you, Curate, for the opportunity once again to present what the fund is all about. So, the Curate Momentum Balance Fund is one of our key instruments in terms of ensuring that we cover a number of different factors in order to pretty much take care of the best form of investment opportunities that we see out there, to take advantage of as many opportunities in the most measured manner in a balanced format, multi-asset, meaning both domestic, offshore, fixed income, property, and in obviously a strategic allocation format. So just briefly, the key portfolio managers within the fund: Jonathan Myerson, who heads both the strategic allocation aspect of the fund and is also head of the fixed income part of the fund. I am responsible for the overall equities positions within the fund, and we are guided by Jonathan and his team in terms of the strategic allocation. And Mpegelo is second in command in terms of the equities opportunities, with a greater focus on the SA aspect of the portfolio. Now, in terms of the unique characteristics, if you can call it, no one is unique really, but I think that our background in hedge funds over the past my background over 27 years, and Visio's background as the manager of the fund since 2003, so that's 22 years now. Our background was in hedge funds, and hedge funds is all about mitigating risk and preserving capital. And it goes without saying that at the end of the day, the best way to generate returns is to lose the least amount of money. And the returns will come thereafter from avoiding as many losses as possible. And it's never been more pertinent as it is currently right now, with the amount of volatility in the markets, with what's happening around tariffs, Trump administration, and geopolitical risk. And when we say we invest with a margin of safety, it's once again not something that you can kind of measure, but it's again focused on our primary mindset is how much money can we lose on this investment? What is our margin of safety? What is our downside risk? And if you can, at best possible, avoid some of the downside risk, returns will take care of themselves. And in saying that, we will therefore tend to avoid popular stocks in many instances. We potentially will not make as much money as others when markets are flying. But on the other hand, when markets are dropping and when there's a lot of pressure around, we tend to have a far more resilient portfolio. And obviously taking into account the strategic allocation framework, which also drives our overall stock selection and fixed income selection as well. And obviously geographically, more or less within a South African context or a global context. If we look on the next slide, it's again, we launched this fund in 2024. We launched our hedge funds in 2003. And in the last 22 years, we've had many, many instances of incredible volatility. My background goes back to 1997 at Liberty Asset Management. And again, I've seen since then enormous amounts of crises and some market collapses, etc. And so been there, done that, got the t-shirt, not our first rodeo. And thankfully, we have quite a lot of scars on our back to guide us along the way, even especially at the moment. What I can say is that as of this month, as of this year, our fund is performing well better than the market overall. As you can see on the graph, one cannot predict from month to month, from year to year. So at the end of the day, as I said again, it's all about capital preservation and ensuring that you do not bet the bank on anything as such, and approach in a very measured way. The experience within the Visio team speaks for itself, and the different let's say, well, not so much degrees, but the variety of academics, and say, backgrounds allows us to really pick, from different brains and look at not just numbers as a CA would do, but look from an engineering background. We have two chemical engineers, so they very much look at things in a different way. Strong on mining, for example. Um, we've got mathematical uh, masters, which also tend to think a bit more differently than and look at things in a different manner as to like the way an accountant would look. But essentially, at the end of the day, it's good to have the variety. It's good to we have a member of the team who is in the US, Justin Froneman. Douglas is in Australia, and I travel a lot more between Europe, Israel, and South Africa. And that all helps in terms of really broadening our knowledge, our experience, our network, and getting to experience different perspectives from many different geographies, different people, and actually almost switch out sometimes of the day to day and allow us to think a bit more deeply about what the real issues are. So that's the team. In terms of the makeup of the fund, this is a little bit misleading in the sense that, as we all know, South Africa is essentially 65, maybe 70% global, with a very strong penchant on China, with Naspers process making up 15 to 20% actually of the market. And thankfully for that, because it's been an incredible performer for all pension funds in South Africa for 20 years, since 2003, when Chris Becker made his first investment in China. But we also have the likes of Richemont, we have British American Tobacco, we have the mining stocks, a number of other companies that have really no bearing on South Africa, but thankfully are listed in South Africa. So when we look at this, the geography really doesn't really depict the true makeup of the fund. Even the USA, you look at a stock like Microsoft, where more than 60% of its earnings actually are derived from the rest of the world. Like it's 70% of its earnings are derived from the rest of the world. And that little caption there on Belgium, Belgium is a listing in Belgium that is Universal Music Group that actually sells music around the world and makes very little music money in Belgium itself as a proportion of its total earnings. So this is really just where the companies are listed. But again, it's important to just give you a perspective that we do look at companies in many different places. On the next slide, this is the diversification by sector. That's certainly more telling, and that really does break down the portfolio better. And you can see that it's very well diversified. We do not have an over dependence on technology, which has been a very big driver of growth globally, certainly from the US. We have a slight affinity to what we call insurance, which is probably disproportionate to the overall global MSCI index, but that is focused on the pensions risk transfer market in the UK in the form of all these defined benefit plans that are moving on to the writers of annuities, in essence, reducing the risk in the UK for all their defined benefits and being taken over by the likes of insurance companies like Legal & General, Renet, which is a South African listing, through PRC, Pensions Corp rather, and then Just Group, which is another small listing in the UK, has done very well for us. So I mean, these are just very key sectors. As I said, we're not massive fans of insurance at the best of times because of the accounting difficulties for understanding insurance numbers, but overall there are some really good opportunities in that space. Same with financials. We like the likes of Alexander Forbes, has done very well for us. We continue to think that it's a corporate event opportunity. So there's very specific stocks. We don't tend to migrate to the index. We tend to look very much bottom up, and our focus is therefore much more company specific. And then again, is something that we've done for many years. We are very much involved from an activism point of view, shareholder activism. We write a lot of letters to boards. We don't make it all public. Sometimes we've gone above the radar, at most times we tend to really concentrate on engaging with boards, gauging their willingness to engage with shareholders and to unlock value where value should be unlocked. In other instances, and maybe we don't think management is that well incentivized and should be better incentivized in order to ensure that interests are all aligned. So letters can be very different in their content, but it allows us to get more understanding of companies, to take bigger percentages in the funds of those companies, and to get greater comfort. So in many instances, you won't see those letters, but they are very constructive, and they've allowed us to generate outperformance in our funds thanks to this additional level of comfort and information and understanding that we have of companies and the playmakers within those companies. The next slide is from a fixed income perspective, so not equities, but fixed income, geographic and asset classes versus, and you'll see that it's obviously very much South African based. I think it's important given that we are at the end of the day addressing a South African investor. We are very cognizant of the South African investor's needs within their own wealth management framework. And so we will tend to very much concentrate on domestic fixed income opportunities. We are not oblivious to some very interesting corporate debt opportunities around the world. We invest in corporate bonds. We've been doing it for years. Sometimes it's a better option than a share itself. So these from time to time will come into the portfolio. We will treat it more like an equity than a bond, such as, for example, in COVID time, we bought Sasol bonds at 55% of face value. And, Sasol wasn't going to default, and we got close on 100% of that bond. In other words, we paid 55 rands, 55% of 100 on those bonds, and Sasol bought these bonds back at 100%. So that was an equity-like return from a corporate bond, from a fixed income type instrument. So we have a very large radar of these bonds that we look at. And when credit spreads are widening, given like they are currently, we are, paying close attention. If you can get 8-9% in dollars on some bonds right now, they offer a better return than equities, in all honesty. On to the next slide. Is SA cheap relative to history? Yes, it is, and we all know the reasons. Unfortunately, it's even cheaper if you strip out the international stocks that form part of the slide. On the left graph, it'll be a PE that could even be sub 10 at this point, judging by some of the companies that we're investing in. It's even sub 7 times. So it's ridiculously cheap, but it's unfortunately, there are no clear catalysts as to when the tide could turn, other than what we call corporate events and corporate action, where eventually the boards themselves and the CEOs think, well, we're not getting a rating. Our listing has no merit, and therefore we need to delist, or we need to buy back shares, or we need to break up the company. So that's how we see the cheapness of South Africa, is in terms of how value will be extracted. And we can't rely on outside factors like government policy, etc., because we can see that to date hasn't really worked. P ratio of the US, it is tending towards expensive. We know why. The Max 7 have already rated quite highly, but that's coming down because of factors outside of their own earnings capacity. But with the global ructions currently underway, we will tend to be a bit more, cautious and selective, and we have done so already. And interestingly enough, we are focusing our attention on pure US companies, so not so much the global ones, but things like General Motors right now, or those generating electricity or selling electrical generating equipment, such as GE Vernova, etc. So this is where we've seen opportunities. They may be expensive, but they have a very long pipeline of order books or projects underway to create a lot more electricity. For example, in the US, they are essentially shielded from tariffs because they source in the US, and it's a very much a necessary sector in the US economy. They need electrons, as they call it. They need many, many electrons in the US to allow them to manufacture more. the data centers, and they've just fallen behind completely in terms of electricity generation relative to China, for example. The asset allocation within the fund on the next slide, I think this really just shows that we can at times stray from our strategic asset allocation. As you can see currently, we are very much doing so. We are very underweight global equity relative to what would be strategically the correct allocation. So we've taken a view to actually be rather circumspect in terms of our global equity. It's paying off at the moment. You've seen what's going on, but South Africa, on the other hand, hasn't been left unscathed. So we're not exactly being heroes here. We are just simply being a bit more cautious, and at this point, trying to at least focus on the geography where we have the most control and stay a little bit underweight where we want to just see how things play out. We have edged back into global equities the last couple of days slightly, so that 12 is a little bit more. And in terms of going forward, we will continue to do so. We're not oblivious to the value that's becoming apparent overseas, but we don't want to jump in full guns at this point. So by this gives you a sense that we apply a lot of discretion, and we're not scared to stray if we have to. That is really the mantra of a hedge fund, is to really not be conventional. And obviously always focused on capital preservation. I want to focus on this slide a little bit. This is the South African stocks. You'll be familiar with most of them, or hopefully all of them. In every instance, firstly, the weightings are those of the fund overall. If you take those weightings as a proportion of the equity component, it's actually, you can add 1.5 times to almost 2 times. So you can see we have concentrated portfolios. These may be rated is at 80 billion rand or 75 billion rand market cap right now, so it's quite big. On the other hand, some of the other targets is quite big too, but some of the others are quite small. Invicta, CMH are below 4 billion, but incredible value. Management's buying back shares in Invicta, the company's buying back shares. Interested shareholder in Visa has a large portion of the company. There's incredible value here. Engineering Group really generates a lot of cash, trading at a discount to its full value. So we really see great opportunities here. We are well invested there, and we are working with management to see what measures they can follow or adopt to really either take the company private or keep buying back shares cheap. So in every instance, we are engaging with the boards, engaging with management, and there are others which are not featured here. It's really where we can add value to our holdings. And as I said, we do it under the radar. We're fairly circumspect. There's no point in antagonizing boards or management. On the next slide is our global investment themes. I'll tell you, the list of opportunities is growing now, day by day. These have been our core holdings of late. And in every instance, it addresses what we think is a long-term sustainable demand. Microsoft is more like a utility. You use it, you pay for it every day. Everyone does. It becomes almost a sunk cost. You don't really even notice what you're paying, and it's there because you use almost all of their functions just in every aspect of your normal working day. And then on the right, I mentioned the energy generating companies, AES, Ivanova, 2 outstanding companies in the US. Striker, Teva. Teva is new, more recent. It's fallen a lot, but it's a key producer of generic drugs, actually Israel-based, but most of its business obviously is international, with a large portion in the US. So we're being a bit cautious now. We're going to see what these tariffs look like for pharma groups, but generates good cash, long history, and it's coming out of a very difficult period. So therefore, the opportunity. Striker is the #1 player in the world in medical devices. It's a blue chip, and it's year in, year out generated very sound growth. And and it's something you cannot really disintermediate: medical devices, physical medical devices, hip replacement, and all sorts of things. It's really a very solid, well integrated business. We're very big believers in the AI space and the digital transformation, and therefore the importance in having TSMC as the cornerstone. I know there are risk to Taiwan, but if something happens to TSMC, we're all in big trouble. So, and TSMC is trading on a very attractive multiple, even cheaper now, and it is really just one of the best businesses in the world. So, in a nutshell, without taking more time, I just want to say once again, thank you to Curate. I hope I've covered most aspects of what we're about, and to also give you comfort that number one, we're looking after your money as cautiously as possible. We are looking for returns, but we won't do it with undue risk. We have the tools, we have the history within Visio. The fund allows us to really aggregate all of what we do in the best way possible and express it in our best way possible. And we are once again very honored and privileged to be able to do this for Curate's clients. Thank you.